What's up, family? Welcome back to another week in the markets. Before we get into any charts, tickers, or strategies, we have to start with the most important rule of the game. I am not your financial advisor. The information I am sharing here is for educational and entertainment purposes only. My goal is to help you think like a trader, to understand the moving parts, and to build your own process. You must always do your own research. You are the one clicking the buttons, so you are responsible for your own decisions, your own risk, and your own results. Manage your risk above all else. That's the foundation for everything we do here. The date is January 25th, 2026, and the board is set for a significant amount of action. This is not a week to be passive or to assume that the trends of last week will simply continue without a fight. We have a convergence of major catalysts: blockbuster earnings reports, political headlines, whispers from the Federal Reserve. When these forces come together, the result is almost always the same: volatility, movement. For a prepared trader, movement is not something to fear. It is something to embrace as an opportunity to find an edge and execute a plan. The feeling in the air is one of anticipation, a coiled spring waiting to be released. Markets have been digesting gains and looking for the next major driver. This week promises to deliver just that. Don't get caught up in the noise or panic that often accompanies big swings. Instead, have a clear and simple playbook. Know which events matter most. Have rules in place to protect your capital when the market moves against you. Discipline will pay far more than genius. Let's start with earnings because this is the heartbeat of the week. Midweek is where the fireworks are. We're talking Microsoft, cloud growth and AI margins Meta, ad revenue and AI spending Tesla, margins, guidance and delivery commentary ASML, the backbone of the AI and semiconductor supply chain. On top of that, Apple, Visa, MasterCard, Caterpillar, SanDisk, and Western Digital later in the week, UPS, GM, Boeing, and Texas Instruments earlier on. This isn't a week to chase every ticker. It's a week to be selective, let volatility expand, and take high-probability setups. This week looks like a pressure point on the calendar. The market's quiet consolidation could give way to decisive and powerful movement. Beneath the surface, there is a palpable tension. Big reports from market-moving companies, big talk from Washington, D.C. are scheduled, creating a perfect storm for volatility. That movement, that churning of prices, is a double-edged sword. On one side, it represents significant risk, especially for those who are over-leveraged or unprepared. On the other side, it represents a clear and present chance to capitalize on mispriced assets and to profit from overreactions. If you are prepared with a plan, this kind of movement can be extremely profitable. Opportunity does not arise from quiet, sideways markets. It is born from moments of uncertainty and dislocation. When a stock gaps up or down 10% on an earnings report, it creates a new landscape. When headlines cause a sector to rotate, it creates a new set of leaders and laggards. Our job as traders is not to predict these moves with perfect accuracy, but to be ready to react to them with a clear head and a predefined strategy. Now let's talk about the elephant in the room, another potential government shutdown. Whenever this pops up, markets don't panic immediately, they reposition. What that usually means: short-term volatility spikes, defensive rotation into larger, higher-quality names, pressure on consumer confidence, bond market reactions that matter more than headlines. This isn't doomsday, but it is something you respect. Be extra vigilant with risk management and incorporate the risk into your weekly plan. There's no rate decision this week, but don't ignore the Fed. FOMC speakers and commentary still matter because the market is obsessed with one thing: when do rate cuts actually start? Every word from the Fed gets dissected, but remember this: price action moves before the Fed speaks, not after. Follow the charts first. Headlines second. Any commentary that challenges the rate cut timeline could spark volatility. If a prominent Fed governor sounds more hawkish, suggesting inflation is still too sticky to consider cuts, you could see bond yields rise, you could see growth stocks fall. Conversely, if a speaker sounds more dovish, hinting the economy is slowing enough to warrant earlier action, it could provide a tailwind for equities. Your job is not to become an expert Fed watcher. Understand how this narrative flow can influence short-term price action and sentiment. Identify key support and resistance on the major indices and on key stocks. Pay attention to the bond market, particularly the 10-year Treasury yield. If yields move decisively, don't ignore it. Ultimately, follow the price, respect the trend, use Fed commentary as a secondary input. to understand the why, not as a primary trading signal. So, how do you play a week like this? Don't overtrade. Let earnings make the move, then react. Sell premium where implied volatility is inflated. Protect capital first, profits come second. And remember, cash is still a position. When IV is high, selling defined risk premium, iron condors, or credit spreads can work. Never sell naked into major earnings. Always use risk limits and assume bigger than expected moves. Use smaller sizes, hard stops, or defined risk options on every idea. Plan your trades before the market opens. Know your exact entry price, your stop-loss level where you will admit you are wrong, and your price target for taking profits. For earnings plays, consider the post-earnings drift. Some continue for days, others reverse immediately. Your goal is not to hit a home run on every trade, but to consistently hit singles and doubles while avoiding big, account-crippling losses. This week is shaping up to be a classic trader's market, not a hype market, not a chase market. Volatility creates fear. Fear creates opportunity. Opportunity rewards preparation. Protect your capital at all costs, then execute when your pitch arrives. This video is for educational and entertainment purposes only, not financial advice. Do your own research and trade responsibly. If you found value, like, subscribe, and tap in with the new Black Wall Street. We build assets over excuses.